Welcome to the Deep Dive. Today, we're tackling a huge question buzzing around the markets. It's got everyone from pros to, curious learners like you really thinking. Is $4,000 gold the absolute peak, like a massive bubble about to pop? Or are we actually looking at a new baseline?
It's the big question, definitely.
Yeah, gold and silver prices have just exploded. Historic levels. It feels like a real break point. And for this deep dive, we're leaning on a bunch of analyst reports that have been tracking this monumental surge. They're saying, be excited, sure, but also be really careful about the market mood right now.
Caution is definitely part of the conversation.
So our mission today is pretty clear. We need to unpack what's actually driving the surge, look hard at this idea of an overcrowded market, and, weigh the odds. Short-term correction, some are saying maybe back to $3,600 versus the longer view, right? The potential that's maybe fueled by these bigger ongoing economic forces. What does hitting $4,000 really mean?
Well, you really do need a balanced view here. If you just look at the momentum, say, since late 2022, gold's been on this undeniable tear. It's smashed through some major barriers, both psychological and technical.
And it's not just a small bump, is it? The numbers we're seeing are, frankly, kind of staggering. Our sources point out gold has set 41 record high closing levels just this year.
41?
Yeah, think about that. That's almost 4 new highs every month. It just captures the sheer intensity, doesn't it?
It really does. And you can't ignore silver either. It often plays second fiddle, but it jumped right alongside gold. Massive surge there, too. Recently hitting an all-time high, over $50 an ounce.
Wow, over $50.
Yeah, and seeing them move together like that,
yeah,
it suggests something systemic is happening, not just, a fluke in one market.
Okay, so this $4,000 target, it was talked about, right? Major banks mentioned it earlier in the year. But actually hitting it seems to have kicked off this almost panic. Is this the top?
It's fascinating. Because this anxiety, this peak question, it's almost predictable. We've been here before.
How so?
Well, think back about 3 years ago. Gold crossed $2,000 for the first time. Same questions. Then it hit some pretty tough resistance near $2,400.
I remember that.
And then again, when prices started nudging towards $3,000. Same story. Is this it? So the key thing, the takeaway from the history the analysts point to, is that both times, those barriers, which felt really solid at the time they eventually broke, and prices went significantly higher afterwards.
Right.
So it really makes you ask, doesn't it? Is $4,000 just the next temporary ceiling? Is the pattern going to repeat and push us towards, say, $5,000?
That historical angle is, it's really valuable. Resistance is there to be tested, maybe broken. But okay, let's focus on the warnings now. If $4,000 is potentially just another step, why are analysts sounding maybe a bit more cautious this time compared to when we broke $2,000 or $3,000? What's different?
I think the difference is really about the speed and the sheer amount of money that's piled in recently. This rally feels different because of the explosive growth in investment demand, specifically. And it happened over a really short, compressed time frame. This isn't like slow, steady buying from big institutions over years. This is rapid inflow. And that always carries a higher risk of volatility.
We need the numbers on that. How big was the rush? Give us the scale.
Okay, so let's look at the World Gold Council data. They track investments into gold-backed ETFs, right? Exchange-traded funds. In the third quarter alone, investments in those jumped by a record 221.7 tons.
Wow, tons.
Tons. And in dollar terms, that's nearly $26 billion, just flowing into these funds very, very quickly.
$26 billion. In just one quarter. That's a huge number.
It is. And because of that surge, the total amount held in these gold ETFs is now just 2% shy of the all-time record set back in 2020.
Okay, so based on that metric.
Based purely on that inflow, you have to say the momentum trade is crowded, undeniably. When everyone rushes in at the same time, the risk of a sharp pullback, just a technical correction, goes way up.
That sounds like a classic bubble signal, though. If $26 billion just poured in, isn't the market just dangerously full?
But here's where it gets nuanced. And this is maybe why it's not a straightforward bubble call. Yes, the momentum looks crowded, but what about the bigger picture? Like actual asset allocation globally?
Meaning how much gold people actually hold overall.
Exactly. Even after this massive run-up, experts point out gold still only makes up about 2% of total global assets under management.
2%. That feels surprisingly low given all the noise.
It does, doesn't it? And if you compare that, well, many mainstream financial advisors actually recommend holding significantly more. You often hear figures like 5% to 10% of a portfolio in precious metals, as a hedge against other risks.
Okay, so 5 to 10% is the recommendation, but globally we're only at 2%.
Right. So connect those dots. While the short-term trading, the psychology might look saturated, maybe even overheated, the long-term underlying ownership base, it seems far from saturated. Think about it. If the wider investment world just moved from that 2% average allocation up toward, say, 5%, the amount of new capital that would need to flow into gold would be absolutely enormous.
That completely reframes the crowded argument, doesn't it? It's not just about recent flows, but overall positioning.
Precisely. It shifts the debate away from just, is this a short-term bubble?
Okay, that's a critical distinction.
Mhm.
So if the trading is crowded, but the fundamental allocation isn't, let's dig into those fundamentals. What's the economic gravity pulling the price up towards $4,000? Are those factors still strong enough to maybe make this a new higher floor?
Well, the fundamental case for holding gold hasn't just stuck around. By most accounts, it's actually getting stronger, structurally deepening. The core reasons that likely push the price to $4,000 are still very much in play, and in some key areas, they're intensifying.
Okay, what are they?
The sources consistently list about 5 key drivers, and we
Yeah.
should talk about how they're deepening, not just that they exist. You've got ongoing geopolitical and economic uncertainty,
Check.
stubborn, sticky inflation,
Go with us.
rising fears about recession, maybe not immediate, but lurking. Then there's swelling government debt, a big one, and maybe the most critical, declining confidence in the U.S. dollar and, frankly, other major fiat currencies as reliable long-term stores of value.
Let's pick one of those. Government debt. We've always had debt, right? Why is it such a powerful driver now compared to, say, 10 years ago? What's changed?
It's the scale. It's
Yeah.
just on a completely different level. 10 years ago, debt to GDP ratios, yeah, they were concerning, especially in developed economies, but maybe arguably manageable
Right.
today. The debt loads are just geometrically larger. And importantly, the cost to service that debt, even with interest rates that aren't historically super high, it's eating up huge chunks of national budgets. Unprecedented amounts.
So it's not just the total amount, but the burden of paying the interest.
Exactly. And it's also about the perception. The perception that central banks have kind of painted themselves into a corner. They can't really normalize monetary policy, raise rates significantly without risking some kind of major financial instability or even crisis.
Lack of options.
That lack of maneuverability, yeah. It erodes confidence in the whole system's long-term health, its solvency, and gold. It's just doing what it has historically done, acting as a kind of sovereign hedge against that systemic financial stress.
That definitely makes the argument for $4,000 being a floor, or at least a new baseline, feel much stronger than the argument for it being a final peak. If the foundations of traditional finance are showing deeper cracks.
It becomes very hard to argue that gold's rally has hit its absolute ceiling. The foundational reasons for holding it are still incredibly compelling. These aren't just short-term trading trends. These look like deep structural issues. And maybe $4,000 is just the price reflecting that new reality, not some temporary hype.
Okay, that lays out the compelling long-term picture. But we absolutely need to address the short-term risk. Let's be blunt. We've seen incredible returns. Over 50% for gold. You mentioned silver, up over 70% this year.
Stunning numbers.
Yeah. After a sprint like that, what are the realistic dangers? Why shouldn't someone listening just say, great run, I'm taking my profits now?
Well, look, after any huge move like this, some kind of correction, or just a pause, a consolidation, it's not just possible, it's probably healthy for the market long term. It lets things cool off, shakes out some of the less committed money.
So what are analysts pointing to?
Some are specifically flagging the potential for maybe a 10% correction from the recent highs, given how far and fast we've come.
10%. That's a noticeable drop. And that leads to the $3,600 per ounce figure we mentioned earlier. Why that specific number? Is it just a round number, or is there something technical there?
No, but $3,600 isn't just pulled out of thin air. It roughly lines up with a really key technical level, the breakout point back in November 2022. That was the level that really kicked off this whole massive rally we've been discussing.
Ah, okay. Old resistance becomes new support.
Exactly.
Yeah.
That's a common principle in technical analysis. So that $3,600 area becomes a potential floor, both psychologically and technically, that some analysts are watching very closely.
I sense a but coming.
But context is crucial here, especially for you, the learner. Even while issuing these warnings about a possible pullback, the sources also stress how incredibly resilient gold has been ever since this rally started back in late 2022.
Resilient how? Give us the data on that.
Okay, get this. In that entire period, since November 2022, The market's only had one instance of a 3-week losing streak. Just one.
And how bad was the drop then?
Prices only fell about 2.8% during that stretch. Pretty minor, considering. And the biggest actual decline they noted, it was about 6.3% over 2 weeks last November. But here's the kicker. It was immediately followed by a 6% rebound the very next week.
Wow, so dips got bought up really quickly.
Very quickly. It suggests there's significant underlying demand of money waiting on the sidelines ready to step in on any sign of weakness.
Okay, so that paints a picture. A correction to $3,600 is definitely plausible, maybe even healthy.
But the track record suggests any dip might be relatively shallow and short-lived, met with pretty strong buying interest rather than signaling some kind of collapse.
Right. So let's try and bring this all together, synthesize this deep dive.
Yeah.
What we're seeing at $4,000 gold is, well, it carries clear short-term risks, right? The market momentum is crowded. There's a real threat of a correction, maybe back towards that $3,600 level.
Correct. Caution is warranted in the immediate term.
But on the other hand, the powerful and seemingly deepening macroeconomic backdrop driven by huge structural debt, questions about fiat currency stability that suggest the long-term case remains really strong, making $4,000 look potentially more like a new foundation than a final summit.
That sums it up well. And the strategic takeaway for many analysts seems to be about finding balance. Given the amazing run we've had, taking some profit off the table, it doesn't necessarily hurt. It's just prudent risk management.
Locking in some gains from the sprint.
Exactly. It lets you consolidate those gains without totally abandoning the long-term view if you still believe in it.
Okay, so here's a final thought, maybe something provocative for you, the listener, to chew on. We've talked about a market driven by, well, both fear of systemic issues and also by the volatility of crowded trades. In that kind of anxious environment, what's the real hedge? Is the best financial hedge actually psychological? Is it about knowing yourself, knowing when to maybe step back from the day-to-day heat, consolidate your position a bit, reduce your own anxiety so you can actually stick with your long-term strategy with more clarity and security?
That's a really interesting angle. Managing the emotion as much as the asset.
Yeah. Something for you to mull over as you think about how all this applies to your own approach to the markets?